You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Simonillo. Hey guys, it's a great day to be a real estate investor. Glad you're listening with us on the Reinvest Podcast. Got a good one for you today. And it is relevant to a pain point that we've all felt. Some people probably feel better than others post April 15th, and that's tax day. We get pretty excited about real estate and tax advantages.
You know what? I think there's just a lot of opportunity right now. I know I'm on like a...
You're coming off a high right now.
I feel like I'm amped up.
Yep.
But I just feel like there's a ton of opportunity out there right now. And I know the last few years for investors has been hard. And it's been a lot of missed expectations with sellers. It's been, the interest rates rising. It's all the things. But if you adjust your strategy and adjust your deal type, and maybe you just have to, you got to move with the punches sometimes. And sometimes, I don't know. So I just feel jazzed up about that.
Yeah, no, and I appreciate your generalized Oprah Winfrey encouragement to our listener base.
You get a car, and you get a car.
No, it's true. I think what you're saying, though, is that, when you you keep coming up to the plate, you keep taking swings at the plate, you're going to get a hold of one. And really, we talk about this a lot, consistency. I'm kind of like, you want to get me on a pedestal? My pedestal is real estate investing is not easy. Don't buy the clickbait stuff on YouTube. It's hard. Don't have these generalized strategies that they make it so easy. You need to know what you're doing. Find the right advice.
It's very true, but just don't fall in the trap that it's too hard and I can't do it, because there is so much opportunity out there and there's so many different strategies that work. So we'll just leave it at that. So most investors think that taxes are something you deal with after the year's over. But Mark Myers believes the biggest tax savings can happen before the transaction, before the sale, and before the CPA gets the final numbers. And so, Mark, it's great to have you here with us today.
Thanks, Seth. Thanks, Garrett. Looking forward to a cool conversation.
So you are a Floridian that nerds out over tax strategies in real estate. That's my summary. I don't know if that's incorrect or not, but...
No, pretty spot on. I mean, tax strategies we do for all types of income. So real estate obviously is an income that hopefully if you're doing real estate investing right, you can generate quite a bit of it. So whether it's real estate income or capital gain or ordinary income or W-2, we can reduce tax on it. But I know that most of your listeners are real estate savvy, so we can jump in any direction you like.
That's awesome. Give us a little bit about your company. And how did you get into the tax world? What was the genesis of that? I'm sure it wasn't a linear progression, and maybe there was a few stops along the way.
Yeah, for sure. Great question. I love answering it too, because I'm not your traditional, I went to accounting, got my accounting degree, and essentially I'm a CPA or a tax attorney. None of that. I actually, I went to the University of Florida for exercise physiology.
Oh.
I got my master's degree in sports management.
Nice.
Wow. What was the intended end goal for that?
Yeah, well, it was definitely to be a tax strategist, of course. I mean, I saw it clear as day when I was going through school. But
your guidance counselor steered you in the wrong direction.
It's like, Joe, what do you why didn't somebody tell me that even if I'm managing the highest quality clubs in all of America, like Equinox Fitness Clubs, the Bay Clubs in New York City and LA, that even as an executive VP working my butt off like 7 days a week, I'd still be limited to $250,000 a year of income. Somebody should have told me that before I went into that, even though I loved it, right? Because I loved athletics. I loved fitness, wellness. But I didn't realize there was a tremendous cap on upside unless you want to open up your own clubs. And now you're competing with 24-Hour Fitness and Equinox Fitness and all these huge chains. So long and short of it is I got out of that space after operating a number of clubs very successfully for those owners, for those club companies. So when I was an owner, or not an owner, when I was an operator, they would send me to a unit, whether it to be to open up a new store or to, kind of clean up an old location. And I was basically incentivized. My incentive was on EBITDA margins. So I got real good at driving revenue, managing expenses, and just managing a process.
Yeah.
So much so that they would move me, to one club to another. But what I realized is I could speak business language. So when I realized I needed to move out of that industry, I said, well, what can I do? let me be a consultant to business owners. And essentially I went into the insurance space, doing more high-end insurance, like key man insurance, buy, sell, all the good stuff, even some nuance like life settlements. And then what I learned in that space was, because insurance is a lot of tax efficiency. There's a lot of tax efficiency in insurance if you structure it right. But what I learned was this is just the tip of the iceberg. There's 75,000 pages of tax code. There's so many ways to save tax that are not even have nothing to do with insurance. So about a decade ago, I really started positioning myself in this space. And really it was a self-taught thing. So I mean, I have a lot of tax attorneys around us. We have a lot of CPA groups around us. We vet whatever we due diligence on. We're like the hunters. We go find what's available, what's out there, and then we beat it up, like poke holes in it, and we throw out probably 60% of what we find, and maybe 30 or 40% we'll put in our toolbox. And then when we're doing our analysis for a client, we'll say, here's 3 tools, here's 3 resources, 3 coupons. We like to call them coupons. That would be perfect for your your current facts and circumstances. So that's really kind of where I got to from there to here, which has been a fun journey.
Man, that's why you were running like some high-end fitness clubs. And
yeah, it was fun.
Kind of like the Alex Hormozy before it was Alex Hormozy, you know, opening new locations. And
all of my former life, you know, friends and colleagues are like, what are you doing now? You know, because they stuck around that industry and they're lifers and they're in the health and wellness space. But I really enjoy numbers and just optimizing efficiency.
Yeah.
So this was a natural progression for me, just in a different industry. You know?
So your company now, TaxWise Partners, they don't replace your CPA, but they would come alongside your CPA to help implement these strategies when you do your filings or accounting or what?
100% correct. I realize that there's a blue ocean in this space. There's not enough CPAs that are forward thinking because they just have so much on their plate. They don't have time to say what's possible. They know what everybody else does, but what's possible. And I don't want to come in and step on their toes. So we don't do tax filing. We don't do tax prep. We don't do bookkeeping. We don't do accounting. We also don't manage money. So when we save somebody tax, we're not saying, oh, by the way, let me manage your money for you. So most of our business comes from registered investment advisors and CPAs and enrolled agents. That's our primary client. And they generally open the door to their clients that are, hey, I've got a client that's just selling a $10 million piece of real estate and their cost basis is only $2 million and blah, blah, blah. How can you help them? So that's really where we work, our spaces with those advisors.
How do you tell an established CPA that they are not forward thinking and that you should come and help them?
So here, I think I should probably be a little more clear. When I have the conversation with a CPA, it's more like, I would never have that language then. I would say,
I'm being tongue in cheek.
We walk it in. We walk it in and we say, listen, we know that you have a tremendous amount of work on your plate. And a lot of clients, especially your high-end clients or ones that are selling highly appreciated assets, are always asking you, what can I do? What can I do? Oh, is there anything more I can do? Well, we're coming to you to say, yes, there is. And we don't do anything that you do. We just want to increase the value. We want to make sure that you have additional options for those clients that have those questions for you. And we just plug into your model. So we take care of your best clients, and we hopefully help you get more of those types of clients because we're doing things that you may want to integrate into your business, but you just don't have the time to do it.
So at what income level does your services make sense for a client?
We can do some smaller things for business owners that are, call it $250,000 a year of income.
Okay.
But our sweet spot is for ordinary income, right? You know, whether it's short-term capital gains or just taxes on W-2 or business profits, $500,000 or more is our starting point. And then when it comes to capital gain, it really helps if we're looking at $1 million or more of net income on a sale.
Yeah.
And that starts, we can really, I mean, obviously the more money, the more taxes you're going to pay, the more we can help. That's usually our starting point because you do have to buy the tax savings and there is arbitrage. So when we start dropping down into those lower brackets, you know, 20, 15%, it's hard to buy a discount that's less than 15%.
So you said something really good that I think probably goes over a lot of people's heads that aren't in this space. You said you got to buy the discount. Can you explain what that means for somebody who's just now kind of getting established? I have some assets, but I haven't sold anything yet because it's been less than 5 years and I just haven't realized a lot of the appreciation. What does it mean to buy a discount?
Yes. So let's put it in real estate terms. You're smart, so you live in Florida, right? Like me, you're like, I lived in California for 20 years, and I said I love this place, but the the politics are a little wonky, and also the taxes are outrageous, and it's the cost of living is even more outrageous. So I moved back to Florida for zero income tax. And oh, by the way, hopefully homestead will be no property tax pretty soon. Thank you, Governor Ron DeSantis. So
Wow.
long and story short, if you're in Florida and you're selling a property that you've held for however long, or you invested, you flipped it, and now you're looking at $1 million of income. And let's just call it long-term capital gain. You've held it for a year. So no state tax. You got 23.8. You got your 20% federal tax plus your 3.8 net. So you're going to pay $238,000 of tax. Unfortunately, you can't write a Dear John letter to the IRS commissioner and say, "Hell, I love paying my taxes. I'm a great guy. Can you just give me a discount on my $238,000?" Of course, they're going to not do that. So when I say buy the discount, so what can you buy for less than $238,000 that will offset your $238,000 tax?
Yeah. Right.
So that's where I'm going about that business. So we're trying to give you a $238,000 of offset. Well, not offset, an amount that actually gives you a $238,000 less in tax, or XX. And you're buying it for less than $238,000. So maybe you can buy a $238,000 tax savings for $100,000.
Mm-hmm.
Well, then it makes sense. They had $138,000 in your pocket that you would never had.
Right.
You're either going to pay $238,000 to the tax authorities, or you're going to buy something for $100,000 that's going to basically reduce your tax by $238,000.
Yeah.
That's what I'm talking about.
Yes. And why there's certain thresholds there is you need margin to be able to create that kind of tax savings. 100%.
That's exactly right. For example, depreciation, right?
Yeah, go ahead. No. Go ahead on the depreciation thing.
So think about depreciation. For every dollar of depreciation, it saves you $1 in tax. Now, there's rules around that, right? Depending on what type of tax you're trying to offset. Because if you're trying to offset active income, but it's you're passive in that space, then you're not going to be able to offset it. So we always look at how can we take depreciation and make it active, so you can offset W-2 income, or maybe flipping income, right? You're flipping, so now you've got short-term capital gain.
By the way,
real
quick
said,
interjection on that. Yeah. If you're listening to this and you've ever wondered, why do business owners own real estate in an LLC that they rent from? It's to be able to put more passive income on that side of the category and tax it at a lower rate. So just
absolutely
little nugget.
Also, all this changes a little bit if you are a real estate professional designation with what we're talking about right here. But
that's right. Or you're a short-term rental person and you only have to do 100 hours a year, not 750 hours.
I did not know that.
Different rule. Yeah. It's very short-term rental, as long as you're turning it, the average stay is less than 7 days, and you can show that you're doing 100 hours of material participation, managing or overseeing your short-term rental, and no one else, no other individuals doing more than you. Now you can take a cost sector study on your short-term rental, and you can apply it to any income you want. W-2 income, cap gain income, dividends.
That is interesting.
But here's the cool thing. This is where it gets a little fun. We actually say, well, if you love real estate, great. Why don't we give you more money to buy real estate? And instead of doing that same strategy with real estate, we can put you into a number of different solar projects. Why would you do solar? Because it gives you depreciation that you don't have to cost segregate. You get 100% bonus depreciation on 1245 property. So all your federal depreciation in the first year, guess what? The federal government will give you up to 50% tax credit.
Oh, wow. Including the 100% accelerated depreciation?
100% depreciation tax credit. And guess what? We can put people in projects that they can take leverage on, that they don't have to go to the bank to get. The solar business, the solar company will give them the leverage. So now they're buying a $200,000 solar project for, say, $120 cash. They're getting a 50% tax credit. So you get a $100,000 tax credit with $120,000 in. And don't forget, they're going to take $150,000 depreciation right out of the gate. So they literally saved more money in taxes than their dollars in. And that solar project will cash flow for them for 50 years.
Wow. Where's the solar project?
We got a lot of them. So,
so is that part of your, just so I understand, is that where you would be partnering with another company who does solar projects and you're putting the pieces in place, and then it's a benefit to the tax side clients and it's a benefit to the solar clients, obviously, but
100%. Think about us as like, we're no different than the insurance advisor or the investment advisor that's saying this is what you should do with your portfolio. We need this insurance policy, you need this disability policy, and you also need this investment product. Well, that person is going to get compensated by those groups. The insurance companies are going to pay that person. We just do the same thing with your tax strategy. We say, well, you should be a turnkey solar business owner. Maybe you should buy this asset because we can get it at a real big discount, and you can take a deduction for your donation. So now the game changes, right? Think about you're doing a donation, but you're doing it with a non-cash asset, and we can give you something that's worth $100 for $20. So when you donate it, you get a $100 deduction. If you're in a high tax bracket, let's say you're in California, that's a $50 tax savings. We just gave you a $50 tax savings for $20. All you had to do was buy an asset and donate it to a charity that would love to have it and use it. And we have to go out and find the people that are willing to sell the asset at a discount. So the question is always, well, who in the world is going to sell something worth $100 for $20? Well, somebody that has a whole bunch of inventory and their cost basis is $10. They normally sell it at $100, but they're sitting on a lot of inventory and they don't want to fire sell it because they don't want to reduce the value of their. But they got all this inventory, and we say, well, how much are you willing to sell to us for $17? We'll turn it around and sell it to our clients for $20, and they're going to get a $100 deduction, and they're happy because our clients are going to donate it. It's not going to interfere with their business model. Yeah. So long as the donation doesn't, essentially reduce their sales capacity.
You're a real estate broker.
yeah, exactly. Just with just different things. Solar, seeds, land. You got it. Yeah.
Okay. So what's one of the most common, let's bring this back to more real estate centric focus. I love what we've been talking about, really practical stuff for anybody that's in real estate or a business owner. What's one of the most common tax mistakes that you are seeing real estate investors make with the kind of business that you do? I mean, what are some of like the biggest gaffes that you're seeing, or maybe biggest oversights that you're seeing?
Well, if we're going to speak specific to real estate, the good news is that most of the real estate investors that we work with are pretty darn savvy, so they're not missing their opportunities. Sometimes they realize that cost segregation is a great thing to do, but they've held that property too long. So they lose their margin on their cost seg. So I would say right out of the gate, you want to start thinking about cost. If most of our real estate investors are already on top of that one. But if not, you got to make sure you jump on it quickly so you're getting the maximum amount of.
Let me play devil's advocate on that. Is there ever a time where you shouldn't do a cost seg on a larger scale real estate property?
Yeah. I mean, I'd say, listen, you're going to have straight line depreciation over the accelerated. You know that when you sell that property, you're going to have to recapture all that depreciation. So what interestingly enough, if people are willing to take that draw on the straight line, when we help them sell that property that's appreciated, we don't have as many rules around what you can and can't do around that recapture of depreciation. So I'd say that almost in some situations, someone knows they're going to hold it for some time, they want to take the straight line. Then when they're ready to exit, we can give them a much better opportunity for how to flip that house or flip that property without having a whole bunch of recapture of taxes. And so different structures in place. I mean, I guess it's really what is the end.
Yeah. If you know you're going to be selling it in a somewhat quick turnaround, maybe it's not wise to take the 100% accelerated depreciation.
But here's what's crazy. This is a good teaching moment. Okay. I was having this conversation with somebody the other day. Syndicators often will take the tax depreciation or the cost segregation at the onset of an acquisition and use that to kind of boost or incentivize the return for investors to jump into that syndication. But if you're exiting that in 5 years, you have to recapture 100% as though you held the property for 39 and a half years. And I'm going to bet, well, it's not a bet, I know this, that a lot of limited partners that are coming into deals don't understand that. They just see the in the door kind of like, hey, this is the benefit I get today on my taxes for this year I bought into this investment, not any kind of ramification. So now in the last 3 years with floating interest rates and people not being able to take properties full cycle like they thought they were going to, there have been some really sticky conversations between general partners and limited partners, sometimes losing investor capital. And that is a piece of an aggressive strategy that kind of put the investment into a dicey spot. So you just need to be wise when you're looking at prospective investments. And to your point, Seth, maybe it doesn't make sense, but we're buy and hold investors, and that's the mindset that we try to have. That's where money's made in real estate anyway, is by holding it for the long haul, and getting that tax depreciation up front's a big deal if it makes sense for your strategy.
Absolutely. And we do have strategies that we can offset the depreciation recapture as well if we're ahead of the game just a little bit. That's a whole other conversation, but I think that when it comes to real estate, I think that when people understand that, the depreciation play, which most real estate investors do, and you start adding additional elements to that, like, well, I can also get tax credit in addition to the depreciation that I have.
Yeah.
I can actually get my depreciation to offset active income if I have a short-term rental or two. There's a lot of different layers you can essentially add in there to start expanding that tax savings opportunity.
Yeah, the tax credit thing is not something I know much about or hear people talk about very often. The strategy behind how do you get more tax credits. And the only way I know how to get tax credits is to keep having more kids. And so that has a cost of its own associated with it. But so let's say an investor owns, a property. There's a lot of appreciation that has happened. They have a lot of equity in this property. What should they do before selling or before even listing it? I mean, what's kind of the order of operations? When do you guys need to get involved in order to be effective?
Well, the good news is we actually can help them pre or post sale. It's just obviously pre-sale, you have more options. So on your pre-sale opportunity, everybody in real estate knows 1031s. But what if usually when you sell high, it's hard to buy low because the rest of the market's high.
Right.
And then you've got the interest rate issues for refinancing. Where's the market with the insurance rates? So what if you prior to the sale, you could reposition your asset into a structure that would kind of defer the tax bill without a 1031. So now you don't have a 45-day, identify the property, 180-day close rule. You can literally take 3 months, 6 months, a year to find the right property at the right deal and then reinvest in that entity. So a lot of times what we'll do is we'll say, well, if you're going to sell this entity, you're going to sell this piece of property, let's just reallocate the ownership equity into this specific trust. And that trust will have an intermediary. And that intermediary will do the sale for you. So you never touch the money. So if you never touch the money, you didn't take assignment of income, you don't have constructive receipt. So the tax authorities aren't looking at you, they're looking at the trust. But you assign that equity to the trust at the same amount as the price of the sale. So that trust doesn't have any immediate tax liability. So now you have all the money in the trust, right? Less the fees to set up the trust. Yeah. And you didn't have to pay that big tax bill, and you can reinvest in that trust. And as you're taking money out of that trust, now you're paying the taxes over time. So now you can sip the taxes over time instead of guzzle them down, and you can buy back into real estate within that trust too.
Through the trust.
So is that what's called a deferred sales trust?
Or an intermediary trust. The DST is like a licensed copyrighted term because it's one group that offers it, but there's a number of different attorney groups that offer a very similar product. We can also do it in a different way that's even better than the DST, but it does involve a larger transaction.
And does the DST apply to more than just real estate? Like more than real estate sales, yes. It could be other assets or business sales?
Absolutely. Business sales, appreciated, concentrated stocks, Yeah, absolutely.
Yeah, that's
All
interesting.
right, Mark, let me ask you this question because this might be a different spin on a different angle on what we're talking about here. Let's say I am a buyer and I'm working with a seller of property who is facing a large tax liability, and they do not want to sell and they want to pass it on to their heirs for fear of a tax liability in their lifetime. And so they think that's the best way to pass that on. Well, the problem for me as the buyer is I want to buy it now and not have to deal with the children. And arguably it would be simpler anyway, because then, who knows if the kids are all on the same page on how to go about that, right? How can you, as that forward-thinking tax guy, help in a situation for a buyer to kind of educate a seller what options would be available to them?
You make me think, Garrett. Because now what you're doing is you're basically saying, as a buyer, how can I get the seller to sell it to me in a time frame that's forward of what they think is the most ideal time frame?
Yes.
Because you're thinking they want the basis, they want to step up in basis, or they don't want to deal with the. Okay, that's a good question because we're always working on the sell side.
Right.
Yeah. So let me see if I can integrate a sell side scenario into that to make it more enticing.
And let me make it a little easier for you. Let's say that there's a seller who is maybe skeptical of passing it on to their kids because of, making them, here's this big hairy monkey that you now have to deal with. So if they knew there was an option for them to still achieve, an advantage tax savings by facilitating a sale before they die, let's say it's that type of seller.
Okay, perfect. So that being said, the pre-planning obviously allows for them to release that asset, control that appreciation, and control that dollar amount that they would have had to pay taxes on. And then what's going to happen is when they pass that properly structured trust on to their kids, it's multi-generational. So they can continue to keep that trust alive. But the seller of that asset, had a very good tax efficiency when they sold it. And of course, the buyer wants us to buy it now. So the seller does say, okay, I'll sell it now because I'm going to have a much more tax efficient transaction. And I know that my kids can continue to defer tax and be really wise inside the structure for many more years in their life. And they could essentially pass it on to their kids if they wanted to as well. We can do this stuff without trusts too. Interestingly enough, there are strategic trading partnerships that people can invest in. And those trading partnerships allow for you to take the negative K1 that the partnership generates. And because of the type of partnership it is exempt from the passive loss rules. So you can take that negative K1 and apply it against capital gain. So let's just say somebody comes to you and they say, oh, I sold this property. I heard you could help me out with taxes. And we say, great, when are you going to sell it? So let's do some pre-sale planning. And they're like, oh, I sold it 2 weeks ago. I sold it 4 weeks ago. Like, oh, okay, no problem. How much is your income, your net income, less your cost basis and all your expenses, et cetera, that you're going to sell that property for? And they tell you whatever the number is. We say, well, great. That's going to be roughly this amount of taxes. What if you could join this partnership for less than half of the taxes you're going to pay? And that partnership will generate a negative K1 for the amount of your income.
Wow.
Right. So you got let's say you got $1 million of income from a sale of a property. You already sold it. You missed your bus on this trust and creating a trust prior to the sale and moving in there. But you still have the sale and you still have $1 million come to you. Well, you know that you can join this strategic partnership and that you will make money in that partnership. But one of the unique benefits of that partnership is they will produce a negative K1 for you to the extent of whatever it is you need to offset on the other side. And that negative K1 will offset the capital gain. So, for example, you can put $100,000 into the partnership. It'll generate a negative K1 for you for $1 million. In Florida, that just saved you $238,000. 50,000 of your $100,000 you get to reinvest in that partnership and make money with. The other $50,000 goes to the partner. So do the math, right? You paid $100,000. Wow. You didn't have to give the government $138,000. $50,000 is in that partnership making money for you. just stay in the partnership for the rest of your life.
Yeah. So what's the risk associated with a strategy like that? I've not heard of something like that before. So I mean, what's the risk associated with that scenario?
Well, this structure's been around for 26 years. Um, I'd say the risk logistically, like when it comes to partnership risk, is to make sure that the other half of the partnership is continuously doing what they need to do. Because every year, both sides of the partnership, it's a master partnership, and you're buying a series LLC, like an interest in the master. And that master is really the kicker because it's foreign currency trading, and foreign currency trading is basically you don't have if you're in a foreign currency trading business, even if you're not trading the foreign currency, the master partnership is, and you're just trading whatever you want in your little bucket that's associated with it, the negative K1s that master partnership can kick off to your series is exempt from the passive loss rules. So you can use that negative K1 against any kind of income. So you just want to make sure that master partnership that's trading foreign currency remains profitable. And they're always every year doing their accounting and making sure that you have a net negative on their side of the trading. Like their trading is not causing a negative tax impact for you. Because if it does, you need to exit the partnership.
Gotcha.
And here's the thing, when you exit the partnership, you get a positive K1 for the same amount that you got the negative K1. And you don't want the positive K1 because then you got to pay the tax. You want that.
Gotcha.
You want the deferral, right?
Yeah.
Yep.
So it's almost like doing like a partial 1031 exchange. It's a taxable boot. Like it.
Yeah.
Just,
it's, at some point, if you exit the partnership,
tax man cometh.
At some point you're going to get hit.
Yes, but here's the cool thing. Just like step up in basis with 1031, the same rule applies. So if you stay in this partnership for your lifetime, and then you have your estate planned accordingly, your inheritance, your child or your wife, well, now they can exit the partnership, take the positive K1 because they get a step up in basis.
Yeah.
Oh, wow.
So now they don't have a tax liability because it was passed on to the next generation with a step up.
Gotcha.
But if the person that owns it, that acquired it,
yeah, that's an interesting strategy. So
let me hit what real quick, and then I know we're going to our show segments here. But we talked to a guy a long time ago, 1031 exchange specialist, and he was talking about. He said there's one way that you can truly avoid taxes in a 1031 exchange, like not just defer, right? Defer till you die. Okay, so there's two, right? Defer till you die, stepped up basis. The other one was that you can transition into a vacation home and own that over a period of time, and your tax basis will prorate down over a 10-year schedule that you own it. Have you heard of that?
That is phenomenal. I have not. And, whenever there's a good idea, I'm always like, please introduce me. I want to do some due diligence on it because it's something that we might want to integrate in our planning. But that is a phenomenal.
Maybe kick the tires on that and let us know.
Yeah.
Well, that's our job. Our job is to go out there. And I don't think I properly answered your first question. TaxWise Partners was, pretty much created because there's not enough people doing this work and there's a lot of opportunity. So all we do is go out and look for what is possible. And that's another thing that's possible. So now we need to understand that better. And how can we integrate that into our planning, and in the right situation, we bring out that tool out of our toolbox to help that person.
Fascinating.
Yeah. And here's a question for you. You're in this tax niche of like really being strategic about things and maybe looking for those loopholes in the tax code. One of the critiques of this line of work is that really the tax code is really set up at this point for the wealthy, and it really doesn't do anything for those that are mid to low income earners. I mean, is that kind of your synopsis as you've been in this space? I mean, is there anything for people that are lower income earners that they could do that would be tax advantaged?
Seth, I mean, unfortunately, the individuals between 50 grand and 350 grand or 400 eat up because there's not a lot you can do. But I will say for business owners, and that includes real estate business owners, make sure you're not missing the little stuff. Like, are you paying your kids, right? Because you can pay them up to 15 grand a year tax free to them. And depending on how you're structured, you might not even have to pay any employment taxes on that. Are you using the Augusta rule, right? Dwelling in a rental? Are you if your entity, if you're trading, if you got a S corp or a partnership entity, those are usually the most common, or a subchapter S on your LLC. Well, now that's a different person. And I don't know how many people realize this, but you can rent your primary residence to another person 14 times per year, and the income that you get for that rental is tax free. But most people are like, well, that's great, but I don't want to rent my primary house to strangers just for 14 days of tax free rent. But your subchapter S or your partnership or your S corp, it's a stranger according to the eyes of the law. So you can rent your house to your partnership, your real estate investment partnership, 14 times per year. And what is the market rate for that? I mean, in certain areas, you might be able to get 30 grand a year, 30 grand of income that's not taxable. That's meaningful, right? Even if you're at
Yeah.
a 15% tax bracket, you're just having meetings in your house instead of going to the a local, suite at the hotel, and you can just justify that rent. So those are the little. So if you're under 350 in tax or income, those are the things you shouldn't be missing. Or
Yeah.
having if you have an S corp, make sure that you're trying to pay yourself a salary that is reasonable, but less than the $170,000 limit for the self-employment tax, because the delta, if you can prove that, you can pay yourself $105,000 salary and you can take the rest in profit with a $65,000 between the 170 and the 105, you don't have to pay employment tax on that. That's 15.3%. So those are the things
Yeah.
that, you got to pick up and not miss.
Gotcha.
That's good.
No,
That's
that is
really
good.
helpful.
That is helpful. Okay. We're going to move into our smaller pockets segment here. Mark, so go ahead and tell us about a deal that has gone wrong. So this is not the highlight. This is a horror story in real estate, or maybe even tax planning if we want to go that route. So I know you said you had some real estate as well, but it could be any story that you think would be good for our audience to hear. So it's what went wrong, and then more importantly, what did you learn from it?
Sure. So I'll tell you a personal story. I really got interested in liens, and I went to one of those workshops where you learn how to pick up properties on a tax lien.
He said
And
one of
I
those
actually,
workshops.
yeah. And you pay, I overpaid for it. My wife's like, "How much did you pay for that workshop?" And
But
I'm
babe,
like,
the
"Trust me,
money
I'm
we can make from it. You're focused on what we paid. Your
exactly.
mind is so small.
Don't think that way. It's half the glass is half full."
Yeah.
No, she's like, it's 3/4 empty.
That's right. So I said, no, I am going to prove it to you that I will make this money back and some. And I actually did. I actually went to learn that my home state where I grew up, North Carolina, was a certain type of tax lien sale. And I started sending my stepbrother, because I was in Florida at the time, to all the tax. I was looking at what's available. I'm like, go there. I want to buy it if you can buy it. And I snagged a property that was worth about $60,000. This was 15, 20 years ago, for like $20,000 cash.
Okay.
And it was Section 8. It was already
Leased out.
so they basically, but it was a duplex. Half was Section 8, half was not. So I made the mistake of not getting the other half Section 8. And the problem was I couldn't keep a good tenant on the other half. And it was just a nightmare because my Section 8 tenant is not happy because the next side is all kinds of shenanigans going on over there, and I couldn't keep it rented, and I always would have to come back and put money into it to fix it after I rented it for 7 months, and then had to basically
Do a unit turn on it.
Kick the tenant
Yeah,
out and do a
exactly.
unit turn. Yeah, do a trash out. And
So I would say, even though I kind of fire sold it because I was tired of doing that after about 4 or 5 years, I put 20 grand in and I sold it for like 50 something fire sale. So you could say I netted on it, but I did it because as much expense as I had in the turnover, it was kind of a net. So that was kind of like I don't know if that's really,
it was a ton of hassle for almost no profit.
yeah, it was relatable. I could prove to my wife, though, I did spend 20 on it and we got 55. If you don't pay attention to all the heartache and the expenses in between.
So was that the only lien deal that you had bought, or did you buy others?
That's really the only one I did. I basically went from that point. I moved from Florida. I moved to New York City. Started working for the club companies. Got
Yeah.
so busy, I was like, I don't have time.
So that was
But now I
enough.
do a
That
lot of
one,
syndicate. Yeah,
yeah.
go ahead.
That one experience was enough for you to be like, you know what? I don't think I want to pursue this.
I would get back into liens again. It's just be wise about it and know when kind of know what you're getting into. And I was really wet behind the ears. I didn't
Yeah.
know what I knew. I knew I was buying a property at a significant discount, which was great. I just didn't know the ins and outs of managing a Section 8 home and how that works. And, does it make sense for half of your property to be non-Section 8 and the other half to be Section 8? Probably not a great idea. Um, so yeah, it was a learning lesson. But now I'll do a lot of syndications because I just stay so busy with the tax work. I don't
Yeah.
have time to do the heavy lifting myself.
Yeah, it's great.
Well, if you ever need to know a guy who can help you with some tax credits, I'm sure you know who that guy is. So it's like you have the ultimate superpower. All right, Mark, we're going to go into what we call our little nugget. So, Mark, this is the part of our show where you give us a tried and true principle that is kind of at the core of who you are, that you would say, this is why I'm successful, and you think other people can benefit from it.
Great question.
We're going to give you a chance to humble brag on yourself.
Okay, well, I'll start with the highest level of success ratio, and this is I put all my faith into our Creator, and I ask Him for help, and it's amazing. I'm not saying I'm a name it and claim it kind of guy. That's not the way it works. But I think a lot of my success has been because I'm willing to serve our Creator and our Messiah. So that I would say, because if you look at the success on the business that I've had in the last 5, 6, 7 years, it's definitely not me. And people that know me are like, you're not that smart, dude. How did you? Not like, well, I think I had some help from the Most High. But if you want to go to another layer to that, I'd say always be. You ever heard the acronym CAN-I? Constant and never-ending improvement.
Oh, no.
Can I? So constant and never-ending improvement is where I am, and always being willing to learn, not knowing that you don't know everything. Because the minute you think you know everything, you stop growing. So I'm always in the can I grow, constant, never-ending improvement, and the learning mode. Can I learn something new? So don't be afraid to learn, even if you think you know it all. But also be mindful, because you have to make sure that, like, even the people that love to learn so much sometimes can go down these rabbit holes and get lost in them. You just wasted so much time on something because you should have known better to go deeper in that rabbit hole.
Yeah.
So that being said, always look for improvement, constant, never-ending improvement. Can I always be ready to learn? And even if you think you know it all, but once you go down the rabbit hole to learn something and you realize because your knowledge is not going to work, don't try to figure out how to make it work. Oh, but what if we just leave it alone and go look for something else?
Yeah.
That's what I think that's where I've been successful in, because I have to look for stuff and I have to look for things that might not be right. And I want it to be like, hey, this tax strategy looks awesome. This will be great. I want it to work. Oh, by the way, this section code, when you line up here, is a step transaction. Okay, well, it sounds great until you get audited, and now somebody's going to lose their shorts, and I never want to put anyone in that position,
Yeah,
right.
So
no, that's good.
First of all, I like how you said that at the top of the success matrix is serving your Creator. Seth and I were just leaving an appointment, and we were having this exact same conversation on the phone back from the appointment. We want to be quick to give glory to God for what He's done in our life, and who He is, right? And one of the cool parts about what we get to do is it seems like we get to rub shoulders with some really awesome people, a lot of awesome people, but then awesome people who are really faith-minded. And it's not just a token thing, but it really is something that's core and foundational to the way that you operate. And I'm with you. I don't think God guarantees and our success, and it's an exchange of, like we're talking with taxes, like I buy a discount, but He is faithful and He always goes above and beyond. And I know I've seen that in my own life, and I appreciate you highlighting that on the show for people, because it's really important. And then, just being a student for life. Like, That is the fun part of our industry: real estate, taxes, finance, business. I mean, part of why I'm drawn to entrepreneurship is it's never ending learning. And it's a constant looking, like I have to look at the man in the mirror every single day.
Mm-hmm.
And I get to look at, I like what I see or I don't like what I see, but there's nowhere else to look. So that's great. I appreciate that. All right.
Absolutely.
We got another question for you, and then we're going to land the plane here. It's been a great episode so far. What's been one of the best resources in your business development?
Masterminds. Yeah. It's really a metric of having 4 or 5 or 6 people that you can interact with consistently that are always sharing ideas and willing to give you insight on what they just learned. Even though they might think, oh, I can't share it with that because they might get an edge on me, So having those
Right.
4 or 5 or 6 people that are willing to learn because they know that the tide will rise, with everyone if we're all playing, So I think it's really having that mastermind that's people you trust and people you can continually interact with that all have that can-I mindset. Because when they find something, you find something. When you find something, they find something,
Yeah,
so let's drill a little deeper because we've had this a couple times, and it's a recurring theme that's it piqued my interest. First question would be: do you think that it's always the right time to be in a mastermind? Because normally those are paid, or is there a time that people reach in their development or place in business where it then makes sense?
Well, if it's not, depending on the cost, you have to weigh it out. But I've found that masterminds that are kind of fabricated or forced aren't really the best because there's no trust involved. And even though people are throwing around ideas, like how do you know if they're how legitimate their idea is, their concept is? I think that's a good platform to find the 3 or 4 or 5 people that you can learn to trust and you can walk with. And this is the same way with spiritual, your faith. Finding those 4 or 5 men that can walk with you and keep you accountable and ultimately pick you up when you fall. Same thing in the mastermind for real estate. Finding those 4 or 5 or 6 other people that really love real estate and different types of investing, et cetera. And you find them by going into those groups. But maybe you pull out of those groups once you find the 5 or 6 and you run with them. Not saying you can never let anybody else in your circle, but to your point, I wouldn't say I'm going to wait to get in a mastermind group until I'm more experienced because maybe you find 4 or 5 other fairly inexperienced people and you grow together. Because what I guess to your point, if somebody knows a lot and they've been in the space for 30 years and they're trying to formulate their 5 or 6 or 7 people. Well, why are they going to bring you in when you know nothing and you're brand new to the mastermind group? But there's got to be some other young men or young women there that are younger but eager, and you grow together. So
to define terms a little bit, when some people say mastermind, they're saying a paid, structured group of accountability. Usually at a certain tier, right? There's tiers of net worth. Some of them have thresholds to get into them. You're speaking even a little more broadly and saying find a group of people that you can sharpen each other. You're like-minded. You're heading in the same direction.
Yes, and you don't really have to join. You don't have to join a paid mastermind to do that. Obviously they're trying to expedite the process, but when you're just going to learning seminars, or you're just on LinkedIn, or you're on these social media, makes it so much easier. Now you're just talk to people. You talk to enough people, you'll find 5 or 6 people that are similar mindset, that are going after the same things you're going after. Now you have 6 people you didn't have to pay for a mastermind to find. If you're willing to be a little bit more patient, find it.
So my next question then is, what are you doing for a mastermind? Like, are you in a paid group? Is there a certain organization, or how did you find your 5 or 6 guys?
So with regard to tax planning, it really has been a metric of me week over week, month over month, year over year, seeking out relationships with CPAs and investment advisors. And in that process, I have basically got a group of around 8 to 12, a combination of forward-thinking CPAs, enrolled agents, registered investment advisors, real estate investors. And that's tax attorneys are in that bucket too. So we can all, share in what we're finding and of course poke holes in it. So that's really how I've done it. I have joined masterminds before. Um, but you just got to work at it. Like, even if you're paying to be in this mastermind, it doesn't mean that automatically you're just going to get these downloads.
Yeah. And I think to your point, it is what you make it. It's kind of, you get in what you get it. Like, what you put in is what you get out. So if you're putting effort into those relationships, like any networking, you will get more out of it, most likely. If you're being intentional with the networking, if you're being intentional with the mastermind. Yeah, if you go there, show up even to something paid and you're beat bopping around and you're not taking it seriously, you're not going to benefit. So either way, paid or unpaid, I think the moral of the story is, are you putting in the effort and doing the right things to make it effective? So
Mark, this has been awesome, man. We've talked taxes before, but this is really the first time that we've jumped into some of like the true forward-looking aspect of real estate investing and assets, and really how to kind of play this game the right way. So thank you for the value add here today for our listeners.
Yeah.
In closing, what would be a good way for people to follow your success or get in contact with you?
Yeah, thank you so much. I appreciate being on this podcast with you. It's been fun. I always say keep it simple. Just go to my website. It's TaxWisePartners.com, right? Just as it sounds, TaxWisePartners.com. We have a lot of information there, but when we have a little link that says, hey, about a 15-minute complimentary appointment, 20 minutes. It doesn't take us, we have a number of strategists. It only takes us 15, 20 minutes in conversation to let the person know what the opportunities are. And then from that point forward, they can determine, do they want us to do an analysis for them? Do they want us to do a little bit of planning? But again, that first conversation, there's no cost.
Great.
Well, we'll put that link in the show notes here. And thanks for coming on the show today.
Thanks for having me. It was a blast.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.